One of my recent TikTok video related to investing for beginners went viral, and amongst one of the topmost questions commented on the TikTok was what and how to start investing. So in this video, I'm going to share with you how you can start investing as a beginner with as little as £100. By the end of this video, you will have learned what, where and how to invest your first £100. Hi, I'm Saj and welcome to my channel. To begin with, let's first listen to what one of the most successful investors of our time has to say about investing.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million.
The two main things I want you to pick up from this particular clip is index fund and long-term vision. So let's first start with what is index funds. Index funds are investment funds that follow a benchmark index such as S&p 500 and FTSE 100. When you put your money in an index fund, your cash is then used to invest in all the companies that make up that particular index, which gives you a more diverse portfolio than you buying an individual stock. So let's first look at what is S&p 500. S&p 500 is a stock market index that measures the performance of about top 500 companies in the US. For example, your Tesla, Apple, Meta, and so on. So if you invest in an index fund that tracks S&p 500, your investment is divided into those 500 companies based on the allocations assigned in that particular index. So for example, 3% in Tesla, 2% in Google, 4% in Meta, 1% in Apple, and so on. To further explain, let's look at another index fund, FTSE 100. FTSE 100 is a UK's best known index fund and comprises of the 100 largest companies listed on the market on London Stock Exchange by market cap. So again, if you invest in an index fund that tracks FTSE 100, your money or investment will be divided into those 100 companies based on the allocations assigned in that particular index fund. So the question is, why is such a diversification so important for a beginner like you and me? Now, the chances are, if you have ever heard investing being discussed in your family, you would typically hear, for example, how one of their friend, family member, or someone they know lost all their money in the stock market, which usually happens quite often when investments are made on risky individual companies, or more so due to using leverage. Investing in index funds take out a huge risk out of the investing journey, as you're not investing in one single company, and the chances of those 500 or 100 top companies going bust at the same time are almost nil. So now let's look at the second part of the equation, which was the long-term investing vision and why is it so important. And for that, let's use our friend Google and see how S&p 500 has performed over the years. So here we have a history of S&p 500 on Google. Now if you look closely at the moment, the current chart is on the daily chart. So you can swap this between 5 days, 1 month, 6 months, year to date, 1 year, 5 year, and max. So let's quickly have a look of how it's performed basically in the last 1 year. So it started around 4,300. Now this is like an index price. It went up to about 4.6 and then it dropped down to about 3.6, and right now it's at about 4,000 roughly. But what I wanted to show is, like, if you go on the 5-year chart, you'll see there's a big dip there. This is when the world hit the pandemic situation, and you can see just before the pandemic hit, it was at the level of 3,380. It was slowly growing, and then you see, because of the pandemic situation, obviously there was a lot of panic in the financial market, and it dropped down to almost 2,300. So that was a big drop. Now when we saw the clip with Warren Buffett, if you remember, we talked about two things. One was index fund, which is something like an S&P index 500 index fund. The second element was long-term investing and why it's important. So you could be a day trader if you wanted to trade daily. That's a different situation, but generally I know most of us would want to invest in something for long term so that you can reap the benefits at later stage, especially like say when you retire. So why is it important is because, say for an example, if you were an investor at this point and when the price was falling down during the financial crisis due to the pandemic situation, if you would have sold in any of these stages and then waited thinking, I'm going to find the right time to buy back in, you would have missed on all these gains which happened after that dip. And that's why long-term investing is quite important, because if you were investing anywhere, say from even like year 2018, if you're investing 100 a month, you would have been investing in all the time, whether that was a dip in the market or whether it's on the top of the market. And there's a term which is commonly used in investing, which is called dollar cost averaging, which I'm going to explain to you in the next session. But what I'm trying to show you is if you go on the max chart and you see how it started, you can see from the time it started, yes, it's had its peak and bottoms, but on an average, the market has always recovered and it's always gone up. What that means is if you're investing long term, you don't have to worry about these dips. In fact, you could consider this as kind of a Black Friday sale in a way. So in the next session, let's look exactly what is dollar cost averaging. So let's look at the term dollar cost averaging now. Dollar cost averaging is a practice of investing a fixed dollar amount on a regular basis, regardless of the share price. It's a good way to develop a disciplined investing habit, be more efficient in how you invest, and potentially lower your stress level, as well as your costs. So let's look at it in the form of an example. So say for example, you have this S&p500 index fund which costs £10. This is the market price at that particular day you want to start investing. And let's say you wanted to buy 2 units of S&P 500 today. You're going to invest £20 and in return the market is going to give you 2 units of these S&P 500. Now let's say you just started investing into the stock market and just at the early stages of your investing journey, the market has decided to go down and take a U-turn. And due to that, the price of the index fund is not £10 anymore, but it's only £5 for each index fund. And you have 2 choices here. Either you panic sell and take a loss of £10, or you think more like a long-term investor and you think, wait a minute, so the 2 units that I got was for £20. However, if I wanted to get 2 more units now, it's only going to cost me £10 and not £20. So you can use this type of time to actually dollar cost average and bring your average cost down. So let's say if you wanted 2 more units of S&P 500, you go to the market and you say, here's your £10. So you're going to get 2 more units of S&P 500. So now what has happened is instead of your portfolio costing you £40 for 4 units, it's now actually costed you only £30, which means your average price is now only £7.50 rather than the £10 you invested. As time goes by and the market recovers, you are able to bring your cost down to £7.50, which means you'll have more gains on each unit as the market continues to get back to the original price level and even further. When you're investing for long term, you have to remember that you are building these blocks for your future. Your aim is to actually build these building blocks so that when the time comes from your retirement, you have enough money in your portfolio, returns on which will be enough for you to survive on in the later stage, whether you plan to retire early or you retire at a regular age. So now the last piece of the puzzle is where and how to invest. Now there are a lot of options, but these 3 in my opinion are one of the best ones in the UK that you can get started with. So the first one is Vanguard, second one is Trading 212, and the third one is eToro. And in this video, I'm going to use Vanguard as an example. Right, so here I am on the Vanguard's website. It shows you basic details of the company, how long they have been operating. So as you can see, it has one of the lowest cost as well. They charge you only about 0.15%. Again, they have been an industry leader. They have been operating for over 45 years. When I talked about Trading 212 and eToro, those are quite good when you want to do individual shares. Although if you like a little bit more app-based access, then those are the options you would go for. And they do have a S&P 500 funds, which I'm going to cover in another video when I do a dedicated video for Trading 212 and eToro. However, if you want access to more variety of funds, then Vanguard is the place you can start with. I'm assuming you don't have a account with Vanguard at all. What you're going to do is on the top right hand menu, it shows open an account. So you click on that. Because you are a new user, you would click on start my application, but make sure you have these details ready before you start an application, because you would need them. They won't be able to open your account without these details. So you hit start my application. Now here you have 4 choices. The one that we are going to be using is called Stocks and Shares ISA. Pension is obviously self-explanatory. General account is an account where when you run out of your 20k allowance a year, which is tax-free, you can invest into another account, but obviously the gains on those accounts are taxable. And junior is for kids, so you can open a ISA account for your kids as well. Again, I have an account for my 6-year-old son, which I'll cover in a dedicated junior ISA video later on. So let's click on open an account. Now, this is why I was talking about why you start with the stocks and shares ISA account and not the general account, because in UK you're allowed to invest up to £20,000 in this account, which is tax free, and that's each tax year. So how does it work? You just apply online, takes a few minutes. Once it's open, you validate your payments and everything, and you would be good to go. Once again, it just reminds you what details do you need. So if you're making a one-off payment, it's 500 minimum per fund. But if you attach your bank account and you want to invest every month, say like £100 per month, basically you just fill up it's just like a direct debit detail. So it debits your account every month, and then once the funds are into the Vanguard account, you can use those funds every month to either put it in the same index or ETF, or you can choose from the 80 available. As they said on the first page, they have more than 80 funds on their website. These are the basics needed for your eligibility for opening a stocks and shares ISA account, which is you are a UK resident, you don't live in the Channel Islands or Isle of Man, you're not a US citizen, US passport holder, or US person for tax purposes, you haven't opened a stocks and share ISA account in this tax year. What that means is, as I said, there are different options available. So you got trading 2 and 2, etoro, and lots of others, free trade, and a lot of other options as well. But because this account has a tax-free allowance of up to £20,000, and to make it easier for tax purposes, in each year you can only use one of these websites to contribute to your ISA account. So say for an example, in this tax year you started with Vanguard, but next year you decided, okay, I'm only using 1 or 2 funds which are available on the app-based providers. Then basically you would stop using this. You can keep your funds in here for lifetime, but for that particular year or the next year you will start using your trading 2 and 2 or etoro. That means you won't be able to contribute on Vanguard, and it kind of resets every tax year. You are allowed to swap between the apps and the websites that you like in each particular tax year, and as a default you are at least 18 years of age. So once you hit continue, it's gonna ask you all your basic details, like the username, the password, the email, and all those details. And unfortunately, because I've already got an account, I won't be able to go and show you further screens, but it's just like signing up for your bank account and stuff like that. You'll get verification emails, you upload your national insurance documents and stuff like that, and once it's approved, and I'm going to show you what exactly it looks like once you are registered and you log in. You can see I'm currently logged into my ISA account. The current value of my ISA is £606.02. This is the personal rate of return, so how much I have gained since I opened the account. Now, I did open this account almost like a couple of years ago. Unfortunately, as you understand, after pandemic, the situations changed and I didn't have enough excess funds that I wanted to allocate it, because I was investing my money in other places as well, which I'll probably cover everything in another video. But this is how much my portfolio has grown: 21.24% in about 2 years, and I invested about £500 on. So let me show you basically what kind of funds are available on Vanguard and what I invested in. So Vanguard has different kind of fund mix, basically depending on what kind of your risk factor is, whether you want to buy index funds that cover UK, Europe, US, or even funds from Asia. The one that we discussed on earlier, which was the S&p 500, I'm going to show you what those funds look like and what kind of gains they have given over the period of time. So as you can see, you can filter based on the region, the risk level. They would have different funds which has a different allocation based on how much is your risk appetite and stuff like that. Initially, don't get too much confused with it, but initially you can get started with something very simple like a FTSE 100 or a index fund that tracks S&p 500. So I'm going to show you the one that I have invested in, which is selected the US region. So it shows me the funds that are available based on the US equity market. 2 you see here on the chart are the ones that I have invested in. The first one is an ETF index fund. The first one is an ETF, which is S&p 500. The second one is a US equity index fund. Let's go one by one so you understand what each one of this is and what kind of returns it has generated until now. So this one almost tracks the S&p 500, which is the top, which is the 500 companies which we talked about earlier in the video, like Apple, Tesla. So there are about 506 companies. The ongoing charge, now this is the charge which the company charges you to maintain. So they charge you that to manage this fund. So let's just show and see what we have here. So as of 28th Feb, they have about 503. Now, just like how each share has a price, each of those index funds have a kind of a unit or a share. So it makes it easier for you to invest in them. So as of today, 3rd March 2023, each unit of this S&p 500 ETF fund is priced at £63.69. So say for example, if you bought one of these units, your investment of that 63 will be divided within this 503 stocks based on the allocation it has been assigned in this particular index fund. So these are the past performances of the last 5 years. Now again, it's never guaranteed that it's going to replicate exactly what it is, but when you look at some of the funds and their history, you get an idea of what you can expect. And once again, if you look at the charts, you'll see ups and downs, which is why we have discussed earlier, you have to plan for long-term investing and not for one particular year, because you never know how an index fund or market is going to react in that particular year. So if you look at the last 5 years, obviously, as you know, this year has been a lot of retracement because of the growth in the last 2 years after the pandemic hit, and then there was a free flow of money in the market because it was cheap money. You can see the market is down the S&P index fund as a whole is down by 8.16%. However, this fund is down about 7.97%. But if you look at last year, it was up 16.7%. The previous year, which was the pandemic year, was 30.92%. So it ended up growing 30%. The previous years were about 7.81 and 4.26. So once again, you can see why is it important to have a long-term investing plan. Now this one shows based on lump sum basically how much you would have grown. So if you invested in this fund £10,000 in May 2012 when this fund started, your $10,000 would be worth almost about $36,000 now, and at its peak it was $42,477. Time in the market and not timing the market. So it's all about investing consistently over the period of time for a long period of time. Now the ticker symbol for this particular fund is called VUSA. You can find similar ones or almost identical ones on Trading 212 and etoro as well, which I'm going to cover in upcoming videos. So on this screen it shows you how it's performed over the period of time, market value in GBP and also in USD value. As discussed earlier, why exactly are these safe, just like Warren Buffett has said in his videos, and we discussed it earlier in the video as well, because these are divided into a lot of different sectors. So say for example, someone investing in Tesla at 200 and then Tesla went down to 100 few days ago. Now again, for long term, it's fine because you know it's going to recover, but why would you take a risk on one company when you can spread your investment into 500 companies and different sets of sectors? Because remember, not all sectors would have a problem at the same time. So when you have a diversified portfolio or funds that you invest in which are diversified into different sectors, you are more cushioned against any kind of major risk. So the way this particular fund has allocations are based on the percentage it mentions here. So information technology, so tech kind of sector is the biggest one in most of the S&P 500 funds. It's 26.5%. Healthcare, financial, industrial, consumer discretionary, communication services, energy, and so on. So this is how the fund is made up of, and these are the actual companies that make up of this particular fund. So Apple has been allocated for 6.29%, Microsoft 5.38%, Amazon 2.67%, Tesla 1.36%. So when you buy a single unit of VUSA, which is 63.69, basically that gets divided based on these allocations. So that £64 approximately gets divided based on this percentage. So let's now see how each of my funds have grown since the time I invested in them. So as you see on the screen now, these were the two funds which we discussed earlier. So the S&P 500 was the one which I showed you in detail. I allocated £226.17 on VUSA. The current value is 254, which means I've gained about 28.60 on this. And the second one is the US index fund, where I allocated £308.95. That's worth 347.3. And you'll see I started with £500. So this is my initial deposit, 21st January 2021. After that, I haven't put in any money yet. Let's get back to the video now. So as you can see how easy it is to start your investing journey. And also if you're someone who's looking for side hustle ideas to invest, so that you can have more money to invest every month, make sure to check out my side hustle videos to get some more ideas how you can make some extra money to invest. I hope you found this content helpful, as I have more content related to investing coming soon on this channel. So make sure to subscribe and hit the bell icon so you don't miss out on the alerts when a new video is posted on this channel. That's all for now, and I hope to see you in the next one. Peace.